How much money can I add to my life insurance policy? Have you ever wondered that question? A lot of people we work with ask this question, and it usually happens after they've owned a policy for a number of years. What's the total dollar amount I could add to my life insurance policy? You know, when you look at a cash value life insurance policy, and I'm specifically referring to whole life, what's the worst year about any whole life insurance policy? Even if we beef the cash value up as much as possible with a minimum base premium, what's the worst year that everyone hates and typically why people don't do this? It's usually the first year. I've got a negative hit on my money, meaning I have less money in cash value than what I paid in. And what I have heard from most individuals is, I don't want to go through that. And if I can prevent ever having to go through it again in the future, sign me up. And I 100% understand that feeling. So what's interesting about cash value life insurance policies is that you, the policyholder, can often add more money to an existing policy. We can make up for lost time. So in this video, we are going to go through an actual policy. This will be a fun case study because we get to see how much he's paid in thus far, the actual cash value performance. So you get to see the actual break-even point, fell between years 4 and 5, which is sweet. And then what it looks like if he's to make a large catch-up payment. So to demonstrate what I mean when I say catch-up payment, or let me actually set some of the groundwork first. We've got a 50-year-old individual, started the policy 5 years ago, and he was 50 years old at the time. What non-smoker reads is this is the health rating he received. So he did not receive a preferred or ultra preferred rating, just a standard non-smoker rating, which is right around 80% of what people receive when it comes to whole life insurance policies. And if a policy is designed for maximum cash value, if I look at a non-smoker, preferred rating, or ultra preferred, there's not a huge difference if things are designed properly with respect to maximizing the cash value. So in this guy, actual policy MEC catch-up. Before we just go through this, let me touch on something here, is when it comes to the MEC limits, and we've got some content that goes through this in full detail, but specifically with the MEC limit, if a life insurance policy becomes a MEC, which stands for Modified Endowment Contract, what happens? We have to deal with taxation on the cash value anytime we access it, specifically referring to the gains. But when I look at the actual MEC limit, let's assume you have a policy like this individual had of $50,000. If you do not max fund a policy, meaning you don't pay all the way up to the MEC limit, so let's assume you have a $50,000 MEC limit and your actual payment, let's use round numbers, is $10,000. Just for the first year is specifically what I'm focused on here. What that means is you had a limit of $50,000. You only paid in $10,000. So you could have added another $40,000 to this policy, but you did not. You didn't want to, you didn't have the money, whatever the reason was, you did not add those dollars. So what happens with the MEC limit, it resets each year. So when year 2 rolls around, the limit resets at $50K plus any unused space from the prior year, which would mean what? Your true MEC limit would be $90,000 that year. And unused space continues to roll over year to year unless you make a big catch-up payment. So for example, if in year 2 you said, hey, I want to throw 90 grand into the policy and make up for lost time, can absolutely do that. And then year 3, what would happen? MEC limit would reset at the $50,000 or wherever we set that MEC limit initially. So let's get into the actual example here. We're going to look at some in-force illustrations as well, but beginning with this, here we go. How much can I add to my policy? So we've got a 50-year-old individual, and here's the actual funding period, the funding schedule he's followed thus far. So year 1 and year 2, he paid in 50 grand. That was his plan, paying 50K per year, exactly what he did. Cash value performed quite nicely, but when we set the policy up, look at this, his MEC limit was just about 50K, $51,000 to be precise. It was a little bit higher. I just used round numbers for this example. So what that means is he paid in $50,000. He could have paid in $51,000. So what this means right here is we have an unused $1,000. I could have paid in another $1,000, but I did not. So I've got this $1,000 that will roll over. The next year, I pay in $50,000. My MEC limit is 51, so I've got another $1,000 of unused MEC space, plus the $1,000 from the prior year, which is why we see $2,000 of extra dollars he can pay into the policy if he wanted to during the second year. Very easy to follow, isn't it? We're going to go through a chart shortly. I've got it laid out on Excel. But then here, and this is often where people will ask, what's the total dollar amount I can add to a policy? It can become difficult to track very fast, especially if you're not into this kind of stuff. If you're not an insurance nerd like me and the people that work here. But year 3, he pays in $8,000. So what that means, his MEC limit is what? $51,000 per year. He paid in 8, if I could write straight when I'm standing sideways here. So what does that mean if you look at the math there? Well, he could have paid in another $43,000. So 43 plus the $2,000 from the prior years, which is why we have this additional $45,000. The 43 extra that year plus the $2,000 from the prior years. Year 4, he paid in an oddball number, $68.31. That's actually the true underlying base premium in this example. And then year 5, paid in another oddball number. This was actually the exact dollar amount he wanted to pay in, $39,169, just based on his cash flow. And then year 6, which is actually coming up next year because he recently made this payment. What's the maximum dollar amount I can add to my life insurance policy? Well, taking into account all of the prior years, $152,000. And a couple dollars extra on top of it. I just rounded down in these examples. So what I want to add before we get into the case study is when it comes to making large PUA deposits. Number 1, his base premium is about $68.31. The insurance company limits, this particular insurance company limits, when we look at the premium and PUA limitations, which I talk about frequently, is the total payment can be 10x the base premium. Annually, they will not accept more. So if I try to submit a policy where I have more than $68.31 going in, so there's my base. If I tried to submit a policy with $70K per year going in, they'd kick it back and say this policy will not be approved for sale. A lot of companies do that. However, when we are making up for lost time with MEC catch-up contributions, they do accept it. We've done this for a number of years now. It's almost never an issue, or I should say it is never an issue, never has been. So we can make up for lost time and exceed the insurance company's standard premium and PUA limits when again, we are making up for lost time. That's step 1. Step 2, this is very important to be aware of, medical underwriting. So when it comes to adding money into PUAs, if I want to throw, call it $150,000 into PUAs, if I'm 55 years old, that's going to buy me, call it another $450,000 to $500,000 in death benefit. That's a lot of life insurance. Many insurance companies will not allow that. Or before they accept it, they'll say, hold up, before we accept your large PUA payment, we want to put you through some type of medical underwriting. Because an insurance company, and an underwriter especially, is going to look at it and think, okay, why are you suddenly adding this huge lump sum of money to a policy? You and I would say, because I'm interested in the cash value, I just sold a piece of property and I want to shove it into my policy. The underwriter will think, and this is not necessarily a suspicion, but it's them protecting the company, how do we know that you don't have some illness or your health has declined since you started the policy and you're at a higher risk right now? For all I know, as an underwriter, you could just be trying to cash in for your beneficiaries. Do they always think like that? No, but at the same time, their job is to protect the company. So where I'm going with this, with underwriting, is if the policy is not set up properly, depending on the company's premium and PUA limits and how we can add funds, we may have to go through medical underwriting if we want to make a large catch-up payment like this. In this particular case, he will not have to go through any underwriting. Typically, how you avoid this with a lot of the major mutual companies, which is primarily who we use, is if you have a 1-year term rider attached. The reason why is when I dump money into PUAs, when I have a 1-year term rider attached, my whole life death benefit goes up, the term rider amount comes down proportionately, and my net death benefit stays the same. I'm going to illustrate exactly that with the in-force illustration when we walk through it, just to help provide some more context there. Now that's more important for us as an agent to know, but if you're a consumer or potential consumer, if you're interested in a policy, just some of the justification behind it, there's some stuff that goes on the back end, just where we need to make sure the policy is set up correctly so you can really use it fully for the cash value benefit and not find out about something after the fact. So that's right there. OYT required. 1 year term rider is required to avoid medical underwriting. Options we've got here. Here we go. So what we're going to look at is option A, stop the funding after a lump sum payment. So specifically, year 6, we are going to illustrate just this. $152,000 paid into the policy, making up for lost time, and then 0 payments thereafter. And then second, what it looks like if he says, you know what if I do decide I want to continue to pay the base premium? Can you show me what that will look like? And the answer is absolutely. We can show a million options as well, a million other options, but we're just going to stick to 2 today because we often provide a ton of info. And I'm told, slow down sometimes. So let's have some fun with this. And what I'll begin with actually is this guy. Let's begin with the 1 year term actually, and then I'll come back to the MET calculation as we went through that with the whiteboard demonstration. So with the term rider, here's the example where he is going to max fund it. So he's made the payment this year already of the $39,169. That's how much he paid in policy year 5. This is an in-force illustration, which is why we do not see years 1, 2, 3, and 4. Begins at year 5. You'll notice not year 1. But here's the payment he wanted to make year 5. Here's the total cash value. Now keep that number in mind, especially if you rewind the video or go back to the whiteboard demo, we actually see exactly how much he's paid in year over year. So you can look at this and say, okay, he's 5 years in. Does he have more money in cash value than what he's paid in, or does he still have a negative internal rate of return on his cash value? So many people we work with, especially those making large dollar figures between 6 and 7 figures per year, look at that closer than anyone else. What's the actual growth rate year over year? That's what they're interested in. So I'm interested in it as well, if the consumer is especially. But to get back on track with the OYT here, very important. Here's your 1 year term rider, amount of 1 year term. What do you notice here? So year 5, in blue, he makes a $39,000 payment. Year 6, here's the big catch-up payment. $152 goes in. $6,800 and change is the base premium. A couple $100 toward term insurance. Everything else just plowed into PUAs. What do you notice about that 1 year term? Look at this. Drops quite a bit. The cost drops with that as well. What do you notice about the total death benefit? In this particular example, remains level at $900,000, as long as 1 year term is still attached. Once it burns off, then you'll notice the death benefit increases as it's pure whole life at that point in time. But back to the liability from the insurance company, the underwriter's perspective. If in year 5 he dies, a net death benefit of $900,000 is paid out. If in year 6 he makes a payment of $152, his cash value experiences a nice jump because he's dumped a lot more money in. But if he dies, how much is paid out? $900,000. The net liability to the insurance company is identical. They don't experience more risk upon large PUA deposits. So it's interesting just to kind of see it from their perspective. Now let's get back on track here. So this is the example where he max funds it or makes up for a lot of lost time and then pays just the premium. And then we've got the other example as well, which is funding just year 6, nothing in year 7. Here's the premium that's still due, but he's not paying it. It's being paid by the policy through dividends and interest. And then on the next page, here we go. We hit the kill switch with a reduced paid up option. You notice no premium column at all. Total cash value continues to grow. We're going to look at these two side by side. We dropped all the info to Excel. Before we do that, let's take a look at the MEC calculation again, because this part can be difficult to follow, and the whiteboard demo can be helpful, but at the same time, this is better. So he started his policy January 2018 to be specific. $50,000 payment, that was the net dollar amount he set in, 50 grand, MEC limit's 51,000, which means he has rollover space of $1,000. I could have paid it another $1,000, but I chose not to. Maximum dollar amount he can pay in, another $1,000 in the first year if he wanted to. Year 2, January 2019, pays in 50K. Annual MEC limit, I should write here, annual MEC limit, $51,000 plus, or I should say $51,000, so you have $1,000 of rollover space for that year alone. So when we look at the maximum allowable payment, it's $2,000. The reason why is we want to take the rollover space from both years. That's the total dollar amount he can add. Now, year 3 is where it gets interesting. January 2020. That feels like just yesterday, doesn't it? January 2020. We're in 2022 now. Who knows where the time goes? I pay in $8,000. Annual MEC limit is $51,000. So based on the annual MEC limit, I could have thrown in another $43,000, but this is the fun part where your agent lets you know, or it's us if you're working with us, did you know actually the total payment is about $45,000 because the prior 2 years, you had another $1,000 in MEC rollover space. Same thing, 2021, now you pay just the minimum premium. Annual MEC limit, 51K. I could have paid in another $44,169, tallied up. With the unused MEC space, I'm at $89,000 and change. Now he says, hey, I'd like to throw in some more money, a little under $40,000, $39,169 to be precise. 51K MEC limit for that particular year, another $11,831 plus the $89,169, which gives me what? $101. So when the big catch-up payment occurs, when someone calls up, or if it's you, what's the total amount I can add to my policy? Don't know if we'll hit it, but what's the total amount without triggering a MEC? Here we go. We've got the 152. Annual MEC limit's 51,000. This is where a lot of people often make the mistake, you can't pay in that much because you'll trigger a MEC. You've got to start a new policy. Not necessarily the case, not here, because what do we have? The 101, that's the unused MEC space over the first 4 years, plus the $51,000 this year, which gives me a total of 152. So that's funding it right up to the brim, making up for lost time. So let's take a look at those numbers side by side here. And what do we got? So I did not input the values here, only because I pulled that from the annual statements. Takes me a bit longer. We'll definitely do so in the future. But what this helps track is his total payments thus far. His break even is actually year 4 in this particular example. And you can even tell here as well, because in year 5, he's paid in how much? $154,000 total. That's the payment he just made, $39,000 in change. $158 and change in total cash value, which is fantastic. This is actually the year-end cash value. So this would be around December 2022 because his anniversary date is January. So he's recently made the payment for year 5. But then, hey, by the way, what's the total amount I can add to the policy? Fun stuff, right? So $152,000, making up for lost time. That brings my total to $306. And then the total cash value is $309 and change. This model displays 0 thereafter. There's the cash value, continuously growing. What we did here, and why we see this death benefit decline, let me actually put this in red. Death benefit decline in year 8. I like to refer to this as the kill switch, the reduced paid up option. If he decides to go with this, he forfeits the right to add any additional premium or PUA dollars to the policy. He can pay loans back all day long, but he cannot add more money to the policy. And once we go this route, we can't go back. So that's the disadvantage to it. The advantage is it does enhance the internal rate of return. I didn't include these in this video. We've got them in a million other videos, so I won't add it quick. Otherwise, I'll keep talking this whole time. But cash value continues to grow quite nicely. When you exercise that reduced paid up option, you will see a decline in the death benefit. And this is something we like to model before we actually do this. This way the client knows exactly what's going to happen to their policy before they exercise this. But there it is with no payments. And then what's it look like if he elects to continue to make payments? Here's the same schedule, 152. And if he says, you know what, I don't want to go with the reduced paid up option. What's it look like if I continue to pay my minimum premium? He could also elect to stop the minimum premium payment and just allow the policy to pay for itself through dividends and interest indefinitely. There's not a whole lot of term left at this point in time, so it won't hurt him that much. However, we just wanted to show two quick options here. And there it looks like. There's what it looks like with the growth. Scroll down a bit. But good options, especially in this case or any case when someone has a lump sum of money and they love their cash value life insurance policy because it's starting to really pick up the pace now in terms of the actual growth. What I don't want to hear if I'm the consumer is, oh, I've got extra money. Well, the best thing to do is start a new policy right now if I have room to add to an existing policy. And when it comes to cash value life insurance policies in general, I've got more than one. Got a number of them that I've just added to the table as the years have passed. But what I do like to do is always check my mech space before I open a new policy and just assess, hey, when I look at the actual numbers and such, if I add to an existing policy that is several years old, I'm getting the premium back, it's compounding. If I add to that and I'm already over the expenses, I see a lot more money come back, as opposed to starting all over, have to hit the break-even point. Could I use that money for something else? Like, that's the thought process of so many people that we work with, including myself. So I hope that you enjoyed this video. I hope you had some fun. I always like talking about this stuff with MEC calculations and everything cash value life insurance. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.